Alright, today's video is actually going to be lesson 4 of the introductory course I've created for my new RM Trade Co school community, which is called Debunking Forex and Day Trading, quite controversially. So yeah, it's just basically going to be that entire video. I thought I'd put it on my YouTube because I think it's quite topical and hopefully will help a lot of people out, especially anyone getting into trading and specifically maybe getting sold the day trading lifestyle, hopefully trying to save them a lot of time and money. So if you know anyone who may be getting into trading, maybe for them this video, I think it would really help them out, kind of drive home why specifically day trading is a massive scam, why you're most likely going to lose all your money and waste a huge amount of time staring at pointless charts. Of course, this video is also then in promotion of the new school community I've created. Kind of come over here. If you watched the previous video I just uploaded, I've kind of went into a deep dive in terms of everything within this community and what it's going to be offering. But the main thing I just wanted to flag again in this video is the founding offer. So the first 20 people to join the community will get free lifetime access. So literally nothing to lose. Again, watch the previous video in terms of what we're offering. I think it's really good value. And yeah, won't waste any more of your time into the video. Alright, moving into lesson 4, a coin flip with costs. So in today's lesson, we're going to be looking through 58 years of daily market data and essentially through the lens of the odds of a casino, the returns of a savings account, and then the costs that guarantee that the house always wins. So everything so far we've looked at has essentially been an argument. Of course, there has been evidence and some backing, but more so it's been an argument against day trading and against the way retail traders kind of approach markets, right? And through maths and statistics, how day trading is effectively a scam. So it'd be a controversial one, but I think it'd be really good to go through. So within this lesson, we're going to be looking at a data set of around 14,813 days, trading days for obviously the S&P 500, and then 5,000 days for the euro dollar, which is basically what forex people basically call euro USD foreign currency pair. So here we're kind of breaking down then the data set we were looking at. So we're looking at daily returns of the S&P 500 open to close every day between 1962 and then 2020. The reason it goes to 2020 is just before obviously the COVID crash. And also when I did the analysis, it was a few years ago now. So it gives like a nice clean data set. Of course, if you were to extrapolate it and increase it now to 2026, you still find pretty much exactly the same results. But here you can kind of clearly see in terms of positive days then, the frequency was 52.66%. So on 52.66% of days, the S&P 500 was open since 1962. They were positive, and then 46%, and then 46.72% they were negative days, with the remaining 0.61% being flat. In terms of the return then on those days, so the average return when the stock market was positive was 0.66%, whereas when it was negative was 0.68%. So you can kind of see here slightly higher. And then the frequency adjusted returns then, obviously basically multiplying frequency by the average return, 0.35% on positive days, and then negative 0.32% on negative days. And so you kind of effectively see here then it's close to 50-50, not exactly, but pretty close to a coin flip. And then if you were to actually look at the euro dollar data, which I believe it is down here somewhere as well. Yeah, here it is, where we go into forex a bit later on. It's effectively 50-50, because if you were to essentially flip a coin, say over 10 times, there's a decent chance maybe, you might get heads 7 out of 10, and then it might be tails 3 out of 10. So 70% time you'll get heads. Whereas if you were to flip a coin, say 1,000, 10,000, 100,000 times, the probability of a heads or a tail comes much closer to 50-50. So by looking at a pretty large data set of 14,800 days, we can kind of see how the frequency kind of comes down to 50-50, indicating randomness. But the worked example here, I think, is what I want to drive home the most in terms of randomness and in terms specifically of profitability and expected value. So expected value is a very, very famous, very quite simple mathematical concept. And it's essentially what we're doing here is, in this specific scenario, if we buy the S&P 500 at the open, sell at the close every single day, right? Because if you were to look at this initially, you'd think, okay, on a long enough time horizon, if I just buy the S&P 500 at the open, sell it at the close, statistically, I'm going to make a profit, right? Because the frequency adjusted return on positive days is higher than on negative days. So you can kind of see it here in this example, plus 0.03% per day. However, what that isn't including and not factoring in, and the biggest killer that I think a lot of day traders don't realize, because again, they're not too familiar with the world of brokerages and how the finance world works and operates, which of course we've covered in lessons 1 to 3. But what a lot of these retail traders, and unfortunately, and a lot of these so-called educators who sell courses on like day trading and things like that, is they don't tell you about spread, which is a massive killer, which again we've covered already, commissions, financing, and slippage, right? So slippage is you kind of put that in with spread, because effectively what spread is the difference between the buy and sell price of something. So you can buy a stock, say Robinhood, good example for a reason. You can buy Robinhood stock, but if you want to buy Robinhood stock, it might be, I don't know, $100.50. Whereas if you want to sell it at the exact same time, it might be $100.40. So the spread is effectively that 10-cent difference, which again, in the world of statistics and mathematics, means you're playing a losing game. So if you were to buy something at the exact same time and then sell it at the exact same time, it basically account for no price movement and no change in the price. You've just lost money. Because why? You spent 10 cents on the spread, and then of course, if you don't trade with someone like Robinhood, but a normal institutional broker, you'll also pay things like commission for every time you trade, right? So I think IBKR is who I trade with. I think they charge like $1 or $2 per trade, no matter what. So when you factor that in, so the spread and financing costs, in terms of then you're playing a randomized game on a day-to-day basis where it's just all noise and very, very difficult to effectively forecast randomness, because essentially what you're signing up for is a 50-50 coin flip game where you're paying the house, aka brokers, and investment banks, and whoever's taking the other side of your trade. Sometimes you're effectively paying them to gamble at something which has at best a 50-50% chance of going for you. And now obviously people then who day trade, they'll then purport to say, I can read a chart and I can guess where the market's going based on historical price action, based on trends, all these kind of things, which again, fair enough. But then what that also doesn't factor in is things like human psychology, which again, you're playing an uphill battle. And later on in the series, we're going to be covering a lot of that, where again, we are basically debunk what a lot of these so-called traders kind of purport, where they have an edge in the market. But again, what a lot of these educators don't tell you is who you're competing against, and that's not other humans who also have the human psychology to play against, but you're playing against algorithms and quant funds with PhDs that are running very, very complex models competing against you, specifically on a day-to-day basis. If you're trading that kind of time frame, you're not actually competing against other humans. And so that's like kind of a rant over, but I'll kind of cover it before costs, and you kind of see 300, so 1% per a day before spread commission, which we already talked about. And I guess the main takeaway, practical takeaway, which I've noted here then, is that consistent profitability from day trading is not merely difficult, but you're basically paying against a house edge in terms of their cost structure with financing and spreads. And I've kind of made a point here, which I'm going to go on to in the forex bit, so I won't talk about it now. But it's effectively talking about how a lot of people then talk about, you use margin and leverage then, because of the expected daily return is so low, that you would then use margin and leverage to kind of extrapolate your daily returns from 0.3% to maybe 3%, 2%, which a lot of these educators kind of sell you, right? Or all you got to do is make 2% a day, it compounds, and then, before you know it, you're a millionaire. If you can do basic maths, leverage times 0 is still 0, right? So, for instance, 100 times 0 is 0. 1,000 times 0 is 0. Like you can have as much leverage as you like, but when you're playing such little odds in your favor, before again spreads and commissions, by that time it's negative expected value. All the leverage then does is basically exacerbate your losses. Oh, so I won't go into this section too much. Again, just download the PDF document and read it for yourself to kind of bring home the point. That's all this point really does. So going into my favorite world, then the world of forex, using the same thing as we've already talked about. The frequency here is, as I've said, basically 50-50. The average returns are effectively the same as well, which means you're even more so playing a coin flip in this instance. And the big point I've kind of raised here alongside the leverage point earlier is the fact that the 0.45% is even lower than the S&P 500 daily of 0.66 minus 0.68. And so that's why a lot of brokerages give you absurd leverage, because if you have like a $1,000, $2,000 trading account, these assets are moving by this amount on a daily basis, then in terms of course, your $1,000, $2,000 brokerage account, you're not going to see much P&L movement. The reason you see some guy who has like $2,000 in his account, who then says, "Oh, I've made $100 today," is because they're leveraged like ridiculously off their tits in the nicest way possible. But of course, as I've kind of mentioned, the more leverage you get is great when you're winning, but then something goes against you. Instance, 3.3% at 30 to 1 leverage is your whole account. So it's very, very dumb, very dangerous, and effectively what we call degen trading in the industry. Which, again, if you follow any forex traders who actually try trade live, you'll see this often. They might have a few weeks where they're making pennies, like they make about $20, $50, and they think, oh, if I keep making this, I'll compound it and I'll get rich. And all it takes is a couple bad days, a few revenge trades. They can have as many stop losses as they like, and before you know it, they've blown the account. It happens 99% of the time. And I feel like this graph here is a nice summary then of everything we've talked about in terms of the retail beliefs and people who are very unfamiliar with this industry versus the professional reality of the situation. So here we see the number one retail belief, which is a lot of retail traders believe if they day trade, it gives you more chances to profit. Completely incorrect. What actually is the case is it gives you more exposure to a 50-50 coin flip, each carrying a cost. And so you're effectively paying the house more and more money to gamble at something that doesn't give you any edge. As I kind of mentioned here, more flips are negative. Post-cost expectancy means just losing faster. And so effectively what day trading does is, instead of trading, say, weekly, monthly, whatever, where, again, you can still lose money, with day trading, it just means the brokerage and the other side of the trade, which a lot of times, again, is investment banks, the people on the other side of the trade get your money quicker, which of course they want. The next point then is forex moves fast. So on the forex now, and that's why the pros love it. Again, completely incorrect. The euro dollar, which is one of the most famous currency pairs, has an actual lower daily move than the S&P 500, which a lot of forex traders are selling. They say stocks are boring, especially just buying the S&P 500. There's like no volatility, whatever they want to talk about. But the euro dollar literally is less volatile than the S&P 500 in the whole index. So the only reason it looks like it's volatile and it looks like there's movement and action is because you're, again, leveraged off your tits. Again, a very famous saying, with tight stops, the small daily moves add up, aka, make 2% a day, compound, put stop losses in, you can't lose. Again, completely BS. Frequency adjusted daily returns are should be 0.03. Sorry, I just realized a typo. And then once you factor in spreads and financing, that's all gone. There's nothing left to add up. And then the final retail belief point I want to kind of drive home here is, I'll learn to read the market's daily direction by looking at historic price charts. I'll gain an edge by, identifying trends. So, when a stock hit or when a currency hits two peaks, and then when it breaks past the resistance, it's going to crash. So then I'll short it, and all this, just absolute mumbo jumbo. Whereas in reality, even if you get the direction call perfect on the S&P 500 specifically here, the call yields only a 1% greater day, one time out of 10. So that was kind of the point we've not actually covered or talked about, but hopefully you read through, is section 2. But yeah, I kind of covered the point here again in terms of the information you need to read mostly does not exist at a daily timescale. It's just noise, right? On a day-to-day basis, a lot of these assets, the movements are just noise. It's randomness. There's no actual fundamental, there's no actual reasoning behind it. And trying to make sense of randomness, for me, it's just a definition of insanity, right? You're going round and round in circles, trying to figure out something that is just random. But yeah, I guess that's today's lesson then. So of course we have the key takeaways as always. Pause the screen, read it, download the document, read it, summarize everything we've talked about. I won't go over that again. Nice little saying and quote that I like to give at the end of every episode. And then the usual reflection exercises, which again, you can ask yourself, go through it, kind of drive home the point, and the knowledge checks with the answers at the bottom. But yeah, that was lesson 4. Let's move on to lesson 5.